Hi, I'd like to spend a moment talking about the covered call strategy versus the naked put strategy. One is considered very safe, conservative, and very, very popular. The other considered very high risk and should only be used by the high risk takers as a very bad strategy. So let's take a look for a moment at the P&L of a covered call. If we were to graph a covered call and we owned an underlying asset, whether it's an index, whether it's an ETF, whether it's an equity, and we were to sell out of the money calls collecting a premium, then we would be in a situation where we'd have a P&L that looked like an upside down hockey stick. A lot of people that use covered call strategy take the approach that A, if the stock doesn't move, I collect more income through the premium of selling the call. B, if the stock does go up and the stock or index gets called away, I sell it away at a profit from higher than I bought it, and I still keep the premium from the call. And of course, any increase or any more appreciation, that would be going to the buyer of the call. And of course, if the stock went down, I own the stock anyway, so it doesn't matter because I would lose money anyway. But at least now I collected a premium, which lowers my break even on my position. Makes sense? And you can see why the covered call strategy is very, very, probably the most popular option strategy in the marketplace. Now let's spend a minute and talk about the P&L and look at the P&L on the naked put. If I was to sell a naked put exactly at the same strike as a covered call, it would look like an upside down hockey stick. In fact, it would look exactly like a covered call position. In fact, if we went a little deeper and looked at actually the Greeks, the delta, the gamma, the theta, and the vega, it's virtually identical. So it's saying that the movement, the volatility, the change in delta, and the decay is exactly the same. Now this can't be, because the naked put is a much riskier strategy. The covered call is much safer. But yet the evidence says that it's exactly the same P&L. In fact, there was a study sanctioned by the CBOE, the Chicago Board of Options, to take a look at this issue. And they started to publish an index. They call it the buy right index and the put right, or the put index. And what's interesting about this is when you look into the study, you actually see that the selling of the put at the money actually gives a higher return and a lower standard deviation than selling a covered call at the money. The put right index wins with a lower standard deviation. Well, how could that be possible? One would argue, when I own a covered call, I own the underlying index. When I sell a naked put, I don't own the underlying index or stock or ETF. So if the index, for example, the S&P 500, was paying a dividend, and today the dividend on the S&P is about 2%, you would say that why wouldn't a covered call be better by 2% a year? Because I own the spot and the P&L is the same. When I sell a naked put, I don't own the underlying asset. And I could invest the money, the collateral that must be held up against the put, in the risk-free rate. Let's say the risk-free rate today is 20 basis points. So there would be 180 basis points, or 1.8% difference between the S&P and the interest from the risk-free rate, the Treasury, short-term Treasury. So why wouldn't the covered call at least beat the put strategy by 1.8%? Doesn't make any sense. Well, it actually does, because in the options market, there's something called the skew. And the skew on the market since 1987 has been reversed. And what that simply means is that the demand for lower strike options are higher than demand for higher strike options. Now, there's been many books written about this, and it is believed that a lot of people buy protections, so they buy puts, and a lot of people like the covered call strategy, so they sell calls, and that causes demand for the lower strike to go up because everybody's buying puts, increasing demand, and it causes the demand for out-of-the-money calls to go down. So what you have is you have what we call a reverse skew. In other words, in English, that means that the puts are actually more expensive, have a higher implied volatility than the calls. And this is why, when you look at this PUT index versus the buy right index, you can see that the returns are higher and the risk is lower. In fact, it's interesting that one of the greatest investors of the 21st century, Warren Buffett, has figured this out. His team is one of the largest sellers of puts in the marketplace today. If Warren Buffett's doing it, maybe we should take a look at it. But the bottom line is simply this, that if everybody thinks covered call writing is safe and naked put writing is bad or risky, then take a second look. Because if we can build a strategy using puts instead of calls, maybe we can get a higher return with a lower risk profile in combination with other hedge strategies and within a whole portfolio view. If we can beat the return or get more alpha excess return, then that would be good for you and your clients. Thank you for listening.